So thank you everybody for joining this year's webinar on hospitality. This is our second year in a row that we're doing this webinar, and I'm really excited to have good friends and guests on this webinar. So I want to welcome CoStar Group. I want to welcome KW Commercial Associates, my colleagues on this group. This is a special webinar. We're doing this webinar together where we've also invited KW Commercial agents who are specializing in the hospitality market to be here. This is a combined webinar where we're replacing our monthly mastermind monthly group call that we do with the webinar itself. And so what we'll do is we'll go through the webinar, we'll go through a few slides, and then we'll hand this over to our friends at CoStar, and they will provide us with market insights and market data, what's happening in the market. I'm really excited to host this webinar today. So a little bit about Singh Commercial. Singh Commercial is a hospitality brokerage group that focuses on buyers and sellers and investors, and we maximize their returns within the hospitality sector. We have years of experience in this field itself. We've built a reputation of delivering high quality strategic insights and really customized solutions for our clients itself. Our team leverages lots of market data. We look at folks within the industry to provide this data for us, and we have an extensive network that we have identified as folks who are within the industry itself to help us mitigate the risks and to unlock these potential opportunities for our clients. Singh Commercial, we are a hospitality brokerage company. We're your partner in your possibility. We are here to buy and sell hotel properties for our clients. We do free property evaluations for our friends. So if you have any questions regarding your property, please reach out to us and our team will be able to get back to you shortly. We list properties. We also work with buyers, and we also work with a lot of off-market listings. We often find that our folks who own hotels, a lot of our friends, they don't want to market the properties online for various reasons. And so we're happy to look into that in regards to that. So please do contact us if you do have any questions regarding that. And we do have a proven track record of successful deals that we've transacted in the last 15, 17 years that we've been in business. So look forward to talking to you guys. My name is Rav Singh. I am based out of San Antonio, Texas. And I am one of the specialists within Singh Commercial Group. And I specialize in mid-scale and then also upscale hospitality properties for my clients. I also lead the National Hospitality Group for KW Commercial Worldwide. And of course, we leverage CoStar and other platforms to help our folks buy and sell properties for them. I've also co-founded a group called Spur Equity. It's a small private equity group that, as a fund manager, we place equity and we invest in properties in the multifamily field, in the land development. And now, as of last year, we've started purchasing hospitality properties, for our investors, and we offer those to our clients. And today, if you are on this webinar, you are in for a treat because most of the folks that we know who are joining are industry professionals or agents who are wanting to understand more specifically on what's happening in the market. And so what we'll do today is we'll explore the shifts that are happening in the market and really want to understand what 2025 has in store for us. It is a changing market, no doubt. There's a lot of things that are going on in the market at this point. And so we look forward to seeing specifically from our friends, what those changes might be in terms of understanding what's happening in the hotel industry. And then hopefully we'll get into looking at the market trends for 2025. We'll also look to see how federal policies and the tax incentives are changing the landscape for the hotel industry, and perhaps maybe even look at some opportunities to identify in terms of hot spots that we may want to look at that are thriving in the hotel market as of right now. And there's a lot going on in the tech sector. There's a lot going on just with the P&Ls that our hotel owners are seeing. RevPAR growth is there definitely, but then there's a lot of expenses that are also popping up in the P&L. So we will talk about multiple different things. So if you are here to understand what's happening in the market, you're at the right place. And with that said, I would like to introduce our friends to you today from CoStar Group. I have with me Mr. Jan Freitag and Colin Sherman, both from the CoStar Group. Jan is the National Director of Hospitality Analytics for the CoStar Group. He moved there from STR, which was acquired in 2019 by CoStar Group. In his role, Mr. Freitag comments on the trends that shape the U.S. Hospitality industry. He's a sought-after public speaker and is frequently quoted in publications as the Wall Street Journal, New York Times, Associated Press, Bloomberg, Forbes, basically all the major publications that are out there. So we look forward to hearing his insights for investors, for owners, and also for operators. He holds the bachelor's degree with distinction from the School of Hotel Administration at Cornell University, and received his executive MBA with honors from Vanderbilt University. And with that said, we have Colin here. Colin, I had introduced and I had invited Colin last year on our webinar that we did. And last year we had a good amount of people that showed up on this webinar, took a lot out of it. And so wanted to bring Mr. Colin back again on this webinar. So he is the Director of Hospitality Analytics for the CoStar Group also. Mr. Sherman oversees Texas and the lower southern states of the United States, including collecting and interpreting primary and secondary hospitality data. He brings various experiences to his role, including data analytics, economics, and urban planning, and has worked for economic development firms throughout Central and South Texas. He holds bachelor's degree in government from New Mexico State University and received his master's of public administration in urban planning from the University of Texas in El Paso. And he lives right next to me in San Antonio, Texas. So without further taking any time, I'd like to introduce both Jan and Sherman to you. Welcome to the webinar.
Hey, thanks so much for having us.
Yes, sir. Yes, sir. So, we would like, obviously, I gave a little brief introduction on who you guys are. If you could just take a few minutes, let us know just your background, where do you come from, and then we'll just get into the slides that you guys have for us today.
Okay. Colin, while you put the slides up, let me give you some time. So my name is Jan. I've been with STR for 22 years, and then we got purchased in 2019. And my day job, as Rav said, I ride a lot. I fly around the country and speak a lot. I was just at the Hunter conference. I'm going to share my slides there with you. And yeah, if you're interested in the STR CoStar data, please follow me, follow us on LinkedIn. We're very, very active publishers and contributors.
Awesome. Colin, yourself?
I think you still need to give me permission to share my screen. I'm Colin Sherman, happy to be here. I cover Texas and the U.S. South, not Florida, or Georgia. So I go all the way up to Alabama, cover a little bit of Nashville, and I cover Arizona, another major state. I'm fairly new to the hospitality industry. Not as new as I once was, but working in economics in San Antonio. That's where my interest was gained in hospitality and hotels. As you know, 1 in 7 of our workforce work in the hospitality industry. So it's a given that I would naturally be attracted to the industry. So happy to be here. Happy to talk about metrics. And let's get this started. Okay, I can see my screen now.
All right, great. Sorry about that. I just had a little technical difficulty, but we're good to go now.
All good. Okay, just to make sure, the notes, they're not up there. It's just the screen.
Yep.
Correct. Okay.
We see it.
All right, I'm going to hand it off to Mr. Jan Freitag.
All right.
Cool. Yeah, you can just jump into the first slide if you want. So thanks again for being here. As I said, I was at Hunter last week, Tuesday morning, presented with the other prognosticators, our outlook, which is decidedly more gloomy and uncertain than it was at the Alice Hotel Investment Conference in late January. So we take our macro inputs into our forecast from this company called Oxford Economics / tourism economics. Some of you may have heard of Adam Sachs, who is the head of tourism economics. And this is how they look at the world, right? Uncertainty is suffocating the economy. GDP growth taken from 2.4 to 2. Odds of recession have risen to 30%. I had a chance at an American Hotel Lodging Association event to listen to Larry Summers, the former Treasury Secretary, and his recession odds are now 50%. So things are bumpy out there, you know, and we are seeing that certainly in the noise around Canadian travelers not coming. We're certainly seeing that in people feeling less optimistic. Consumer confidence is lower. We're certainly seeing that in workforce layoffs around federal workers, and also stopping of group travel and other non-essential travel from the federal government. So all of this is not good news. And you add to that the very strong dollar, which still makes it very cheap for Americans to go to Mexico, to go to Canada, to go to the Caribbean and not stay here. So all of this is making us a little, well, uncertain for sure. If you go to the next slide, that is our current forecast. We put this out at Alice. We did not change our forecast at Hunter. Calibri Labs and CBRE both took their forecast down. So our forecast stands at 1.8% RevPAR growth, driven disproportionately by ADR increases. The Calibri number is now at 1.9%, and CBRE is at even 2%. Both of those were higher at the beginning of the year and have come down. You're wondering, hey, if your GDP forecast is down, how come you haven't changed your RevPAR forecast? Sit tight. Who knows? Like, we'll look at the NYU Hotel Investment Conference in June when we have some data under our belt and see if we will take this down. I still like this number. It's growth. It's not a whole lot. If you think about the rate of inflation, CPI is around between 2 and 2.5%. You pick your number. The ADR change is below that, which means that in real terms, when you adjust for inflation, we are this year still 7% below 2019 results. You know, for an industry that prides itself in resetting its prices every night and therefore being able to outrun inflation, this is not a good story. You know, we are not seeing this, oh, we are not an inflation hedge the way that investors think about us. But point being, last year RevPAR growth 1.8%, this year RevPAR growth 1.8%. It's not nothing, but it's not a whole lot. On the next slide, you're seeing, because a lot of you out there are thinking building versus buying, a lot of you are thinking about investing in the space. This is what the pipeline looks like. The number of rooms in construction has been between 150 and 160,000 for 39 months now. So basically what that means is basically flat. So some projects are opening, some projects are breaking ground, but overall, you know, you see here 149,000, call it 150,000 or so. Why is that? Because interest rates are still elevated. And now you're bumping into tariffs and threat of tariffs on Canadian timber and lumber, and on Mexican concrete. So if you're not breaking ground today, things are going to get more expensive for you. You're seeing here the final planning on a contract number. They're actually the highest that they've ever been. Is that worrisome? I don't know. It seems like people are sort of stuck in this final planning phase, you know, and that they own the land, that they design the property, they talk to the brand, and then they go to the bank, and the bank's like, hey, you know, this construction load is whatever, SOFR plus 1,000 or SOFR plus 600. And that's when people sort of sit back down and say, well, I can't afford that. Let me wait for a minute. So let's see where we go with this. But the pipeline has been the same, arguably. Last year, supply growth in the United States was 0.5%. The long run average is 1.6. So new supply is not a headwind. On the next slide, we talk about deals, deal volume in 2024 decelerated from 2023, which decelerated from 2022. You see that the price per room, the blue dot, continues to increase. That is not adjusted for inflation. So of course, everything gets more expensive. So does the price per key. You see on the right-hand side, I just looked at the preliminary Q1 2025 numbers. This is through March 15. We sold roughly $2.7 billion. Q1 of last year, we sold $4 billion at this point. So JLL, CBRE, most of the major brokers have been on the record as saying, yes, 2025, this is the year where we see acceleration in trading volume. Haven't seen it yet. So let's hope that things are going to get easier. I'm just not sure that people are more convicted to lean into the US hotel industry when things get more bumpy on the macroeconomic environment. What could spur some deals? On the last slide, you see it's not delinquencies. This is just CMBS, commercial mortgage-backed securities. So this is a little bit on the higher end normally. But what you're seeing here very clearly is that the delinquency rate of CMBS debt has been between 5 and 7% for, since coming down from COVID. And the way I built this chart is I said, hey, show me delinquencies that are 30 days delinquent, 60 days, and 90 plus days. And 90 plus days is the dark blue line. And what this shows is that there are very few new delinquencies added. The ones that are in the hopper, we know about them, and it's just sort of smooth sailing after that. So not a whole lot of delinquencies, not a lot of owners being pushed by their lenders to put stuff on the market. Now, at Hunter, and for the last 45 days, I've suddenly heard this very different narrative where if you had invested in a fund, if you're an LP, a limited partner in a fund, and the fund was closed end, meaning it was between 5 and 7 years. If you bought a hotel in 2018 or 19, the fund is coming to its end. The life of the fund is coming to its end. And the limited partners are pushing the fund to say, hey, I gave you money, you owe me money, it's 7 years, give me back my money. And a lot of the general partners are swallowing very hard and saying, I was hoping to sell this hotel at a gain and get my promote, my higher return, and I may not. So what I'm hearing is that people just sell the hotel, give the limited partners back their money, and then turn right around and say, hey, would you like to invest in my new fund? There's lots of opportunity out there. So, so it goes round and round and round. So we may see maybe towards the end of the year, a little bit more push of properties being sold just to close the fund, but then to immediately restart it. So last slide, if this is interesting, please follow us. We have a podcast called Tell Me More Hospitality Data Podcast. Comes out every month. It actually just dropped yesterday, the latest episode. The gentleman on the right, Isaac Colazo, the head of data for STR, myself, the Not a Lot of Hair, but a Lot of Good Data podcast. Join us once a month, wherever you get your podcasts. Thank you very much for having me, and I'll take questions at the end. We'll bump it over to Colin.
And I did want to remind everybody that if you do have questions, please use the Q&A feature on the webinar and write these questions, and then we'll basically go over and answer a lot of those questions for you guys.
All right. Thank you, Jan. And thank you, Rob, for inviting us to speak. Again, I'm Colin Sherman, Director of Hospitality Analytics for Texas. So I'm going to go over some of the Texas trends. You'll see that it mirrors the overall U.S., but there's a few nuances there. So let's jump in and go over what we're seeing for hotel performance throughout the state. So room demand, not great. Kind of grew at 1% in 2024, while demand levels for the state exceeded 2019 benchmarks in 2022. The pace has since slowed. So from 1.8 in 2023 to 1.2% growth for the full year in the state. Most demand that we saw year over year, the gains were in Q2 through Q4. And on a market level, room demand saw its largest gains actually in Houston and Texas's central and southern regions. Houston's weather-related impacts were a factor. as was the city's attraction for group travel, which increased by 13% for the year. So a lot of activity in Houston. We're not seeing that so much year to date. In February 2025, it's lowered a little bit, but I think it's also because they were so high last year that it's coming down.
Yeah, a lot of hotels came in the market in Houston.
Yeah. And I also think 2025 year-to-date results show softer demand, reflecting the weaker start to the year, to potentially some of the consumer ripple effects from recent federal policy assumptions, and again, that economic uncertainty that we're experiencing. So following from the previous chart, Houston showed the highest demand growth of any Texas market in the last year. So for 2024, it grew 8.2% in demand. When comparing all other Texas markets, excluding Houston, demand growth was flat. But when including the Houston market, the state's overall demand rose about 1.2%. As we saw in the last slides demonstrating the Houston's market, this really demonstrates the Houston's market's demand influence on the state in the last year. When you look at this from a quarterly breakdown on the right, it shows how this played out throughout the last quarter of 2023 through Q4 2024, with Q3 2024 showing a large surge, which was driven by Houston's demand increase in the aftermath of Hurricane Beryl and a derecho that went through the downtown. And a derecho is just an extremely windy rainstorm, like downgraded from a tornado. It created a lot of destruction, which also increased demand as recovery crews came in. So mentioned this before, among one of the many drivers of the state's demand last year was a sizable uptick in group travel for large meetings, with Fort Worth and Houston and San Antonio showing higher gains above other markets in the state. Fort Worth and Arlington had the largest increase, about 15% in demand, and this was likely due to the 888-room Lowe's Arlington Hotel and Convention Center that's located there. Just speaking to a few market participants in the area, they had a very heavy convention year last year, which helped their demand sizably. Houston drew in sizable group travel, both, as I've kind of already said, not only from the pace of conventions and conferences to the city, but also again from those weather-related events. So Houston's group demand in 2024 increased about 7% compared to the previous year. So another sizable uptick on the group segment. Comparing Texas's, that's really hard to say. Texas's major markets to the secondary markets, we can see that major gains not only came from Houston, but also the top 5 metros. And I say top 5 because normally we put Dallas and Fort Worth into one metro, but our data actually separates those two. So when I say the Texas Triangle, I'm not just talking about the Dallas, Fort Worth, San Antonio, Houston, Austin markets. I'm actually also talking about how separating Fort Worth from Dallas. So Texas Triangle rose about 2% in demand, and then all other markets outside Texas major metros saw flat growth. Again, with the entire state increasing 1.2%. So last year, if you were here, and you've probably heard it many, many times over, our current state is that demand, also with our other performance metrics, there's still bifurcation between the classes. This really isn't a surprise, as it's been the trend since I think late 2023, where luxury and upper upscale class hotels have continued to see higher demand and better performance than other classes. This same trend again is seen in RevPAR, where upper tier properties are seeing about 4% growth, with mid-tier and lower tier properties seeing about 2% growth over the last year. In the meantime, we do expect the trend to continue, as those means to travel to higher end hotels will continue to, while other travelers might be a little bit more selective. I will add that this trend may shift a bit as kind of the stock market continues to drift following weeks of scary swings, both up and down. And this might lead to consumers potentially trimming back on spending. Even those upscale or those with the means to afford upscale and luxury properties might also be tailoring back a little bit. This on top of a suite of U.S. tariffs that are scheduled for next month. We don't quite know what's going to happen there, but it has soured some confidence among U.S. Consumers, which we could maybe see that in the data in the coming months. Just something to kind of note. Excuse me. This is TSA data, which screens more people than ever. It seems like it's always rising every time we look at it. So this is not CoStar or STR data. It's from the government's I-92 data. But on a high level, compared to 2019, international inbound travelers are about 14% higher than 2019 levels, with outbound at 35%, or being 35% higher. So really what you can conclude here is that while international inbound is stronger for the state of Texas, the level of U.S. citizens going outbound is double that of the inbound. Kind of what Jan said, a strong dollar invites people to go abroad, and those leisure dollars that could have been spent in the U.S. have not been. Mm-hmm. And you'll see later that these numbers do matter and that they are another factor slowing Texas market's hotel performance, especially as we don't have enough international travelers coming into the country or coming into the state compared to U.S. travelers going out of the country, despite better results this year or in 2024 versus 2023. And this is leap year adjusted. I put that in the title there. When we looked at it before, it wasn't leap year adjusted, so we did take that into account as well. This kind of folds into or brings us to a topic that we're following along our borders, or at least our team is. There's been a sense of whiplash from the president's back and forth tariff threats and responding retaliation, particularly from our Canadian neighbors and potentially from our neighbors south of the border. Being in Texas, I'm showing the slide that was presented by our team regarding the Canadian border submarkets. This is only 1 month of data, so more analysis is needed, but the topic here is to show how policy is impacting our international travel and international hotel performance, or hotel performance on our borders. We'll continue to monitor this data, especially if tariffs go into effect next month on Mexico, which could impact border city hotel performances. But I just thought I'd throw this in just to kind of also spur that interest with everyone, just that we are monitoring this. So now that I've discussed the demand side metrics, I'll briefly go into new supply. Supply in Texas, top 6 largest markets grew about 0.5% over all other markets. Urban markets are stronger as population and new development continue to grow there, which you'll see in the north, which I'm sure we're all familiar with. Dallas is booming. But it's also growing in the south. Austin is somewhat considered the southern portion. We're seeing a lot of supply increase there as well. So segmenting new supply by regional levels shows that new room supply is again concentrated in the north and south Texas markets, increasing roughly about 2%. So not high, but still increasing. And again, that's at Dallas, Fort Worth, Austin, San Antonio area where you're seeing the most growth. Year-end 2024, Fort Worth and Arlington, which is also located in that north region, increased 3.6% in supply. It saw the most growth, followed by the central north, kind of southern Dallas area, which increased by 3%. Southern markets, again, Austin and San Antonio made up about 1% of Texas's supply growth, and about a 2% increase. 1 to 2% increase. The others being in the border markets such as Corpus Christi and Laredo, which is in the west or in the southern portion of the state. So now kind of switching over to hotel performance indicators. Occupancy is still below 2019 benchmarks. I know it's super weird to still be benchmarking to 2019, but hey, we're not there yet. The only market which did surpass 2019 occupancy levels was Houston. And again, you're going to hear this theme that due to the not only their group travel surges, but also in the aftermath of the hurricane and some of the weather impacts that they had from due to displaced residents. So looking now at ADR, I know this chart kind of looks like a big, bowl of spaghetti, but I think it really proves the point that nominal while nominal ADR has grown about 12% above 2019 figures or comparatively, when you adjust for inflation indexed to 2019, real ADR just still isn't there. We're about 2 index points down in almost every major Texas market.
Colin, you lost the share.
What's that?
Can you reshare again, please?
Yes. Oh.
I can see it, Colin. I see your slide.
Good. Sorry about that.
No, you're good.
I apologize.
Good? Okay.
Sorry.
I noticed our internet. Speaking of weather, we're having a little weather here in San Antonio, and I noticed that our internet's been a little iffy.
Yeah.
So if you take inflation, and as Jan said earlier, your pick 2.8, 2.2, whatever. Texas markets aren't driving ADR as quickly as inflation is going up. Special events like festivals in Austin City Limits, South by Southwest are part of those peaks that you see above that black line, but it's not being sustained. But so largely the state remains about 2 index points on average below. So what this actually means is, and what gives managers and owners some concern, is that compared to 2019, and not talking about ADR, but RevPAR has lost ground if you adjust for inflation. When accounting for RevPAR results, real RevPAR today, adjusted for inflation, is still lower. And that's actually lower by about 5 basis points when indexed to 2019. Get my slides here. Okay. So after saying all that about where we are currently on the hotel front of performance metrics, I turned to this graph just to kind of show an understanding of some of the underlying pressures on performance. So using the total US expenses versus revenues as an example, we see that the US expenses have consistently outpaced revenues, which creates a challenging operating environment. So expenses are growing faster than revenues are, and actually compressing hotel profit margins. Again, this on top of inflationary pressures and potential shifting performance and travel demand could potentially further limit operators' pricing power, making it challenging to reach those 2019 benchmarks. This again also proves the point, just a little bit more additional context. There's also that widening gap between labor costs and revenue, where across the US, and this is for the US, labor costs are almost twice that of revenue, presenting further operating pressures. So take all this, and we turn to look to the current transaction environment. Sales have slowed. Higher interest rates and uncertainty continue to make their mark on investors. Saying this, I wouldn't say that deals aren't getting done, as you kind of mentioned, Rav, because they are, but it may require a little bit more capital to bring to the table, and a few more nuances. Also, investors now, like I said, face a little bit more nuanced evaluation process. So where profitability is likely being carefully weighed against accelerating labor expenses to accurately assess true profit potential. So Texas, being a non-disclosure state, limits some of the transactional volume data from being assessed. So here in this chart, I'm just showing the number of transactions in the state on a quarterly basis. Of the disclosed, this is just kind of a tidbit of disclosed transactions in the last 5 years. The largest transactions to occur were all in San Antonio. I'm not just being a San Antonio advocate here. but they really were. The JW Marriott traded for $800 million, I think last year. It was beginning of last year. I think it was February. The La Cantera Resort in 2023 traded for $327 million, and the Grand Hyatt traded, I believe, in 2021 for $310 million. So looking at transactions by hotel class, we can see that mid-scale class hotels are definitely dominating trade activity in the state. Mid-class hotels may be a little bit more palatable to investors because they require less capital to enter. And they also offer more predictable returns. They also offer some insulation from wage pressures and rising amenity expenses. On the upper end hotels on the market continue to be super interesting to investors despite lower trading activity. Higher end brands are certainly willing to put a little bit more key money into the deal that allows buyers to get a slightly different cap rate, which is worth watching for the upper end and upper tier properties in the Texas markets.
Could you give an example of that, Colin? Because I know people would have questions on that.
What do you mean an example?
On the key money aspect that you were talking about.
I'm sorry.
I thought you had mentioned about that the hotel, companies are giving key monies as incentive, to the hotel owners.
Oh, they're willing to put a little bit higher key
Right.
money to get lower cap rates. This is something that's happening nationally. I can't say that for the state, just because we do lack that transaction data to really kind of see that. But this was more on a national level that's happening. And Jan may be able to actually answer or at least give a little bit better explanation on that front during questions.
Okay. Yeah, it's been happening. So I think the first and foremost example is the Ritz and that Host bought for whatever $700 million or something in Hawaii, where Marriott gave them incentives in order to make it a Ritz. It was an unflagged property, Turtle Bay. If Marriott was asked in their Q4 earnings call about this, I think here Hilton was as well, and the argument is, look, it sort of goes from top to bottom. So yeah, for luxury upper upscale brands, we're willing to put a little bit of our own money at play. The further you go down the food chain, I'm not sure that there's a lot of key money available for Courtyards, or for Sparks. But never say never. If they care very deeply about a specific brand in a specific market, it's very worth having a conversation.
Yeah, I was just about to say the same thing, John. That it's also very, case by case basis. I've heard similar things where folks who have multiple units are able to then negotiate a little bit better than folks who are just entering the market itself. And then the market also makes a big difference in a sub-market that you're in, where you're trying to transact. Yeah.
Agree.
Thank you.
All right. So now turning to our outlook. It's not surprising. Large supply gains will be in the South. We're seeing Texas, and you'll see on the next slide. Texas is averaging some of the highest pipeline in under construction properties and in final planning. You see here that on the supply forecast from 2024, which grew 0.5%, is now 1.3% in 2025. Again, the pipeline remains robust. So Dallas actually has over 5,000 rooms under construction, another 7,000 in final planning. That's the 7,000 again is kind of what Jan pointed to. They're kind of in flux at the moment, but the pipeline keeps rising. And Austin has about 2,000 rooms under construction, about 5,000 in final planning, and then Houston is third with about, again, 2,000 rooms under construction, about 4,000 in final planning. This also just shows the rest of the state where it stands. Again, it's the critical markets of the North and the South here or the larger markets in the North and South in Texas that are showing the most gains in the pipeline. So room demand is expected to see increases in the smaller urban markets, which is really strange when you kind of think about demand. I had to question El Paso when I looked at this and thought, why is demand so high? So I actually spoke with representatives from El Paso on this very topic, and something interesting that has changed my, I guess, view of the city is not only are they seeing larger conventions come to the city, and their convention calendar is stacked for the next year, but another interesting point is they pointed out was that group demand has been soaring and has been rising because of the increased troop activity. So troops stationed on the border as part of the new administration's border security policies are just booking hotels. They're staying there for the short term. So I've seen this increase in the monthly data. I think El Paso's demand went up 20 to 34% in January and February, respectively. So that was something I didn't think about, and I'm assuming that they're thinking that that's going to continue. So again, when we look at the border and how hotels are reacting to some of the new policies.
We're hearing the same thing, Colin. I'm hearing the same thing from from
You are
owners
okay.
that own the properties. They're essentially just leasing out their whole hotel to different groups or different federal groups out there, and just taking vacations or going out and and doing other things.
Yeah, because you're seeing that was the big, I guess, difference was that when you segment it, is transient demand has not changed, and then group demand was extremely high, and so that again, it's really interesting. Occupancy is expected to soften in Texas' largest markets. Lower additions to supply and increased demand will shape occupancy gains in both El Paso and Fort Worth. El Paso is not seeing a lot of supply, but they are seeing high demand. So Dallas and Austin are also expecting, on the lower end, Dallas and Austin are expecting a 4-year plan to upgrade their convention centers, with Austin demolishing and rebuilding their convention center in their downtown, and Dallas partially closing theirs, which will impact demand factors and also lower occupancy in the coming years. Not much to say here. ADR growth is expected to remain flat across the state. San Antonio, all 6, not a lot of growth. San Antonio seeing higher. I mean, it's all about 1%. Except for Houston, which is seeing lower. Like I said, not a whole lot of change there. And moderate RevPAR growth is expected, with increases being in line with the U.S. forecast, about around 1.8%. So this is in Houston seeing that lower level of RevPAR come in, which is probably a return back to normalcy from the highs that they experienced last year. So, but that could change. I mean, that's the other thing with Houston and the coastal markets. Another weather-related event could come through, and we might see that change in the coming year or coming years. So all that to say, the key takeaways is that performance is divergent. It's changing. We're watching it. I mean, it's exciting from my perspective. Maybe not exciting for many others in the industry, but we like, we are watching things change on. I mean, it almost feels like every 8 minutes. Significant gaps do remain to 2019 as we went over ADR and RevPAR, and occupancy. We're not quite there yet as a state. And as a little bit of a little fun way to say this is the only certainty we have is uncertainty. As we do remain in uncertain times, it is going to be an interesting year. So with that, I just want to thank everybody, and thank you for letting Jan and myself present. And yeah, I guess we're ready to move on to questions.
Yeah, no, thank you. Thank you, Jan, and thank you, Colin. Excellent information. Folks that we have with us today, they are from all across the country, not specific to hospitality or not specific to just Texas itself, but Texas being such a big state, and we do have a lot of folks who are attending that are also from Texas itself. So I want to thank both you, Jan and Colin, for presenting the information. We do have some questions, for you guys specifically. I'll go through just a few of them, and then if anybody else has any questions, they can also reach out to you via LinkedIn. I know you guys are really amazing at answering and getting back to folks. So a lot of people that are here are very diverse in terms of folks who are thinking about entering the industry or people who already own multiple units right now. And so folks who are entering the market or thinking about entering the market, this attendee is asking, are there any guidelines for first-time buyers? Are macroeconomics or uncertainties too high for first-time buyers to enter the market right now? Jan, this is for you, buddy.
The age-old question, right? Is do you zig when others zag? Do you say, okay, look, this is everybody's down in the doldrums. This is my opportunity to step in. Bite the bullet, work hard, and then when the inevitable upturn comes, I am well positioned.
Mm-hmm.
The uncertainty that was introduced through the new administration is a little bit different from what we've sort of encountered before. You could make the argument that this is therefore then timed. This is not going on forever. It's only for, call it 2 years or 4 years or whatever, and then we will see more, I don't know, a little bit easier way to forecast. So if you can make it through the next couple of years, then should be smooth sailing. We're not here to give investment advice, but a broker friend told me, when is a good time to sell? Today. When is a good time to buy? Today. Right. So, that's the old adage from any broker you've ever met. Is this time different? Well, the hotel industry, we're bullish on the hotel industry. That's why we're here. I think that's why you're here. We believe in travel and tourism in the long run. We can't speak about specific submarket gyrations or specific sort of demand shocks to the system. But in the long run, people want to travel. People have to travel. So that when you are, providing a home away from home from those people, that's what we're betting on, that in the long run, the hotel industry will be fine. You saw, we're projecting growth. It's not a lot of growth, but it's some growth.
Mm-hmm. No, I agree. And by the way, that was funny what you said regarding brokers, because that's how brokers make their money. But regardless of that, I think I think that I get this question all the time, and I'm sure both of you get this question always also. So what we saw during COVID time period, a lot of uncertainty. We didn't really know what was happening, and then the hockey stick happened, and market just went really berserk. And so a lot of folks are saying, well, we are at a transition. We're at a point where, yes, our market had been going up and up and up for the last 10 plus years, and correction had to come, and this correction was needed in the market. You and I don't have a crystal ball. You guys are seeing data. I'm seeing data. And so, a lot of people are asking that question because there's the shift happening in the market. Will this be a right time? And I love the answer that you gave. As long as you can sustain yourself, as long as you can sort of even, I want to say, like, break even in the market right now, and as the change happens in the market, hopefully, that could look like a good outcome for the property that you purchased today. But it is very uncertain in the market right now. But there are still buyers out there, and there are still sellers out there in the market.
Yeah, let me back up my sentiment with one data point. You saw that the pipeline is very, very small, right? So if you step into a property that needs some love, and you put in the PIP, and you put in some renovation money, you are the new kid on the block for the foreseeable future, because there's just not a whole lot of new supply coming. And you will probably find markets or submarkets where you have nothing on the books. And if you can come in and make your property the new property, I think then, you know, you'll be sitting very, very good
I agree.
for the future.
Yeah, absolutely. And there's a lot of adaptive reuse that has happened with older boxes, older properties getting offline in some of these markets. And so, you know, as they convert into multifamily or other use types, we're seeing that void and having no new development coming in those markets. You know, once again, love the answer that you gave. If you do have an opportunity into buying something older, renovating it, that could perhaps could be an opportunity for the buyer. We have Sid who asked a question regarding which U.S. markets, if any, other than New York City and Boston, um, are now subject to 2025 local law 97 mandates, and that reducing carbon emissions in larger hotels than 25,000 square feet. Are you seeing any other hotels or other markets that are also putting that mandate?
I don't know the answer to that, Colin, do you?
No, at least in my markets, I have not seen anything like that.
No.
Okay.
I mean, when in
No.
doubt, I would look at California, I
I
think.
was just gonna say that.
Yeah. Specifically, I think he's talking about if we're seeing anything increase in any sort of greening the hotels, you know, in major markets from a brand identity standpoint.
I mean, it's sort of, there are not a lot of brands that have made that their main thing, like One Hotels, obviously new Starwood, you saw Starwood is being relaunched, you know, and they're certainly leaning heavy into the idea of green and being good for the planet. But I think it's sort of an undercurrent for all the brands these days.
Mm-hmm.
So I'm not sure I could call out anyone specifically
Yeah.
other than the one brand.
Yeah. Right. And I from a franchise versus non-franchise, do you guys track independent hotels, or do you have any comments on the independent hotel market?
I mean, that is I mean, the Broadmoor is independent.
Yeah.
Right. So that is a wide field. I mean, we're talking about the Jan Inn with 1.5 stars in the middle of, you know, Tennessee, which is not super nice, or, you know, the Broadmoor, which is very, very nice. So independence is basically everything, you know. So we have luxury class independent, we have economy class independent. It's the independent hotels, because there are so many of them. Keep in mind that 1/3 of rooms in the US are unbranded, are basically looking like the US, you know. And what happens in an upturn is that independent properties come back just a little bit later because they don't have the branded loyalty program guests that can be directed to the property. So the independent properties have to fight a little bit harder. But there's a space.
Absolutely. We have another question. Richard is asking, while much of what you've shared is very transactional and economic metrics, what can you share from operational side, operating expenses trends, especially property taxes and insurance dynamics, and especially staffing given current administration immigration enforcement actions?
Do you want to take that, Colin?
Oh my.
I'm happy to. I just want to give you a chance to chat. I'm happy to.
No, I mean, yes, I mean, I'm happy for you to chime in. And geez, I don't even know where to start. I'll start with insurance. I think that's something we're closely monitoring. We do take that into account when we have natural disasters, and particularly as we've been watching the LA fires. That's been a huge question. Insurance rates are going to go up undoubtedly, and how that factors into operations, it factors in. I mean, and it does. I mean, that's something that I think from an operational standpoint, you have to consider. I don't know, you know, with some coastal markets, and also now we're looking at fire markets, or at least where big fires take place. I'm not sure, you know, how an insurance policy is going to work. I don't, and there may be. I don't even know, Jan. Are you hearing from owners or operators that they're not even going to be insured next time around? Or, I mean, what is? I would ask you on that front.
Yeah, I mean, I think at Hunter, there were two prevalent thoughts. One was that this year, the increases are actually not as dramatic as they had been last year and the year before. So people are in general getting a little bit of a breather. Insurance is still going up. But there is absolutely in the coastal markets the question of, will you have access to insurance? The New York Times published a super interesting chart. This was about single family homeowners, but I think this sort of relates to commercial property insurance, that the non-renewal rate for houses that stand in wildfire regions or in hurricane regions is disproportionately up, where insurance companies are just saying, you know what, I'm not even going to touch anything in this wildfire region or in this hurricane-prone region. And the problem, of course, is that if you're owning a hotel and you're trying to sell it, if you're trying to buy it, the mortgage demands that you have insurance. And that gets super duper tricky and super duper expensive. So we haven't seen the last of it yet. I think weather is going to get more extreme. I think the impact on our industry is going to get more extreme. But also keep in mind that a lot of hotels are the last door open, right? We have emergency generators, we have food on staff, we have shelter, and then people get evacuated to hotels. But the insurance question this year is I was surprised, is not as dire as it was for the last couple of years. Things are up. Things will continue to go up, but this year people feel good about the increase.
That's right. That's right. It's very interesting. This one gentleman's asking that someone told him recently that people are renting rooms to mine cryptocurrency, causing power bills to rise significantly, especially in the hotels. Are you seeing that as a problem, or have you heard about stuff like that?
That is new to me.
Yeah.
Yeah. We remember we had people like, what is that, cook meth? It's like whatever the latest, how can you make quick money? You just have to be, your front desk staff has to be on point. Your housekeeping staff has to be on point. They have to communicate, and I have not heard of that specific thing. I don't doubt it, but you just have to be very, very clear. Maybe put it in your, in your terms and conditions. Hey, when you check into this hotel, you just do what an average user does. And if you do something different, use more water, use more power, we will charge you for it. We obviously have your credit card on file. But I have not heard that. That's super interesting.
Yeah, that was first for me also. We'll take one last question. This gentleman's asking, what do you, let's see here, what is deemed to be a healthy occupancy rate in the Northeast markets?
Sorry, it depends. I don't have an answer for that. That is that we can't say that without looking at the specific property.
That's right. Or segment, I guess, of properties itself, and entry level versus upper scale. But yeah, no, thank you. Thanks for presenting the data. I really appreciate that. I think it's always interesting when, because people come in from all different sorts of, where they're at doing business, from entry level all the way to, folks who own multiple hotels, but they all want to hear the data. They all want to hear what's happening in the market itself. And so I encourage everybody to, log on and connect with you guys on LinkedIn and other social channels, and listen to the podcast that you guys have, and specifically, talking about the markets, talking about the data itself. And it's always interesting to me. Every year, market changes, and market is very dynamic, and especially right now where things are happening on the fly. Every month could be very different what's happening in the market. So I specifically want to thank you, Jan and Colin, for coming to the webinar, spending your time. And if there's any other questions, we will ask you on LinkedIn. And is it okay if this webinar slides are shared with the group?
Yes.
In PDF, yeah.
In PDF format. Yes, sir.
Which I think I sent you, Rav.
Yes, sir. Sounds good. All right, great. Well, thank you. Thank you, everybody, for joining. We will try to make this an annual, meeting where we can understand what's happening, given the circumstances with what's happening in the market at that point. And so once again, would like to thank everybody for joining us, and look forward to engaging with you guys in the near future. Thank you.